The agreement is principally about ensuring that there's sufficient capital in the banks across Europe so that if there's another banking crisis, that they have enough capital and capital of sufficient quality to maintain the banks and not to crash out like they did at the start of the last crisis. And added on to that then is an associated issue that bankers' bonuses would be limited. What happened sometimes in the banking industry was that individual bankers took excessive risks to inflate profits in a particular 12-month period so that they would enjoy a very big bonus at the end of the year. And then as the years went by, it became clear that the risks they took actually damaged the banks and damaged the shareholders. So there's a cap now being put on so that in normal circumstances a bonus can only be as big as one's basic salary. And in exceptional circumstances, then shareholders may vote for bonuses, which would be twice the salary. But all of this is to protect the banks, to make sure that we have a much stronger banking system with adequate capital, with the risks of manipulation being reduced. And it's a big step in preparing us for a European banking union.
It would mean that if a banker, for example, had a salary of €500,000 and they did exceptionally well for the bank, that without too much difficulty they could double their salary to $1 million. And then if the board agreed, if they'd had an absolutely brilliant year, they could get up to 1.5 million. It seems very generous, and yet there were those who lobbied against it.
Well, you see, traditionally banks were organised with very low-cost bases and quite surprisingly low salaries in the sector. And then it was made up maybe giving bonuses 10 times basic salary. You had situations in London, if you think back a couple of years ago, reading headlines in the paper that a whole tranche of bankers were getting £1 million Christmas bonuses.
Yeah. So it was like
the base salaries might have been between 100 and 150 sterling.
But it's a bit like a waiter who gets a very small basic salary and is expected to live on the tips.
Well, it is, but you see, the waiter will bring you your dinner, and normally he won't spill the soup all over you. The risk here was that because the incentives were fixed so much on the bonuses, that bankers took very serious risks, which actually damaged their banks for short-term gain to trigger bonuses. And then 2 years later, you were in a crisis because of the risks that were taken. So that's the real fear, and it's not kind of driven by envy. It's driven by a desire to reduce risks, to protect banks. But if it doesn't work out, and if there's a lot of transfers out of the City of London, for example, to places like Singapore and places outside the European Union, there's a review of this built into the agreement as well, and the review will be in 2016.
It appears that Britain objected to this on the basis that there might be a flight of talent and a flight of business. They tried to rally support. Were any other countries helping Britain with this approach?
No, I think unfortunately from their own point of view they were rather isolated at the end. But it's not completely over the line yet. What was achieved was agreement with the Parliament, which is the hardest bit. But it goes to co-repair now, which is where the ambassadors representing the different countries discuss it. So there'll be a political oversight on it later today, and then it will go up to ECOFIN on Tuesday. So there is still some miles left in actually saying the Irish president has this over the line. But the actual decision at the end is by qualified majority voting. So one country, even a large country, can't veto it or stop it.
The headlines, of course, are being made up by the notion of bankers' bonuses being capped. But there is so much else that had to be done to secure the future of the European banking system. For example, to ensure the proper capitalisation of banks. What else is in these measures that we should know about?
Well, it originally runs from the Basel Agreement, and I think people, while not knowing quite what's in the Basel Agreement, are familiar that there was an agreement in Basel about putting extra capital into banks. So the primary thrust of it was putting sufficient capital in to sustain shocks, and then the type of capital would be strong as well, and it would be primary in nature. What happened then is when this went to the Parliament said, look, we have to deal with bonuses as well. And even the bonus wasn't in the Basel Agreement. It was an add-on by Parliament. So it was the Parliament who was driving that. And you can see why, because every Parliament in Europe has been concerned about extraordinary bonuses being given to bankers where the electorate say it was the bankers caused the problem. So you had this pressure, we have it here as well, pressure on elected people to put a cap on bankers' remuneration, particularly on their bonuses, because, to put it bluntly, a lot of the electorate would say you're excessively rewarding the very people who caused the crisis.
And will that regime now, this new regime, if it is to pass, will it apply in Ireland, or will we have our own separate caps on these things for the foreseeable until we're out of jail?
No, it will apply. It will apply in Ireland, but we probably have even more restrictive rules now. We were never into huge bonuses anyway. It's like on the trading floors where you get guys making huge profits trading, that you were getting these enormous bonuses. But there was a heavy bonus system in Ireland as well, but we have dealt with that domestically, and the arrangements we have in place will be well within the new guidelines. So it will make no great change here. But as we have the European presidency, we're doing this job for the European community. Where it affects Ireland is that this is a big building block in the move towards a European banking union, and we're very interested in having a functioning European banking union. That's in our interest.
So all of this is separate to the process that will unfold over the coming years about having a rescue system. Hopefully banks won't get into trouble, but undoubtedly at some point some will. The rescue system that will be put in place that won't involve individual countries' taxpayers picking up the tab.
Well, it's all pieces of the same plan. First of all, if you put adequate capital in, you hope that it will reduce the incidence of insolvent banks, if not totally eliminate them. So that's the first piece, which is now in place. The second piece, which has been negotiated, is a single supervisory mechanism working out of Frankfurt and applying the same rules to the banking industry right across the Eurozone, and indeed with knock-on effects to those countries who don't have the euro as their currency. The third piece then is the Commissioner preparing a paper on resolution. In other words, how do you deal with banks like Anglo that are on the fringe of going bust, and what mechanisms are in place? And again, the responsibility would be moved from the individual countries to a central European agency, so that resolution again would be, you'd be fulfilling the commitment to separate bank debt from sovereign debt, because you'd be making it a European issue. And the Commission have a paper nearly ready on that. And then there's the underpinning of the resolution by guaranteeing through probably insurance deposits of individual savers and individual corporates in the banks. And then there's the European Stability Mechanism, and the rules and protocols are being drawn up to allow the ESM to directly recapitalise banks. So the sequence would be, if this arrangement agreed last night were to fail and banks had inadequate capital, if the banks could be rescued, it would be the responsibility of the Stability Fund to put additional capital in. If they couldn't be rescued, it would be the new policy on bank resolution, which would wind them down and make decisions about, would bondholders be burned, or would all the equity be responsible in the first instance, and what way would that work out? So we are looking at a situation where in a couple of years we'll have a banking system akin to that of the United States, and it will be a functioning trans-European banking system with the controls at central level and being a matter of European responsibility and competence rather within the responsibility and the competence of the individual countries like Ireland.
Finally, Minister, I should ask you, what this does for Ireland, getting this deal. It's not quite over the line, but you're suggesting there won't be too many more roadblocks in its way, given the qualified majority voting. What does it do for Ireland that we are the ones?
It enhances the reputation of Ireland, and it particularly enhances the reputation of our civil servants, who are very good at the negotiations. This has been stuck for several presidencies, and there has been very little movement on it. And the skill of the Department of Finance people who are in Brussels has moved this along, and the diplomatic skills of the various ministers who make contact has has freed up a logjam and got it through. So it's more reputational than practical.
And finally,
but the practical consequences will be there as well.
Yeah. Finally, I should ask you about the bank guarantee and the removal thereof. Any particular reaction to it? I mean, has it been greeted as just a part of the normalisation process? Anyone running away saying, "Oh, don't have a guarantee or won't have 1st of April, I'm getting out of here"?
No, we got very few phone calls yesterday. It seems has been absorbed into the system, and there's no sign of any difficulty whatsoever. And the commentaries are generally approving, both domestically and internationally. So I think we've got it over the line without any problem, and it will end with a whimper at the end of March. At the end of March.
All right. Minister for Finance Michael Noonan, thank you very much for joining us on the programme today.
Yeah, thanks very much.